Welcome to the Deep Dive. Today, we are opening up the financial books of Paychex, Inc., the giant of the human capital management world. We've got their first quarter fiscal 2026 results right here, covering the period ending August 34, 2025. And this wasn't just a standard quarter, was it? It was really the first one where we're seeing the impact of that, well, monumental strategic acquisition start to fully ripple through.
That's exactly right. And our mission for you, the listener, isn't just about reading the headline numbers because, honestly, they are a bit conflicting this time around. We really need to cut through the significant noise created by the GAAP versus adjusted metrics. We want to find the true story of operational performance. Did the acquisition of Paycor actually succeed in its initial integration phase? And what does that really mean for Paychex's future growth?
Yeah, good point. And before we jump into the dollars and cents, maybe let's just quickly appreciate the scale we're dealing with here.
Yeah.
Paychex is, it's an industry-leading HCM provider. That means they offer the full suite, HR outsourcing, benefits, insurance, payroll, the works. As of the end of the last fiscal year, they served nearly 800,000 clients and provided HR outsourcing for about, 2.5 million worksite employees. Huge numbers.
It's a massive operation, and they definitely use that immense scale to their advantage, especially in specialized areas like their professional employer organization offering.
Right. Speaking of that specialization, maybe for listeners who might be newer to this industry, what exactly is the PEO segment? Why is it different from just standard payroll?
Sure. So a PEO, professional employer organization, it's critical because it moves way beyond just processing checks, In the PEO model, Paychex actually enters into a co-employment relationship with the client. They handle pretty much everything from benefits and risk management to, importantly, comprehensive regulatory compliance. It's a much stickier service, more integrated, higher touch than just managing payroll, and it's a huge part of their success. But as you mentioned, the scale of that operation just got significantly larger with Paycor coming into the fold.
Okay, let's then unpack the main event, the Paycor acquisition. It closed back in April 2025. Strategically, why was this deal so essential for Paychex? What was the thinking?
Well, the rationale was really about competitive positioning. The HCM industry, it's consolidating fast, and Paychex needed to extend its reach. Paycor wasn't bought for replacement, it was bought for unification. It brought two highly complementary SaaS platforms together, and these platforms were mostly serving customers of different sizes. So Paychex dramatically extended its position upmarket, which is just essential for capturing those larger clients. This deal, it's designed to open up huge cross-sell opportunities, access new distribution channels, and critically massively enhance their AI capabilities using that newly expanded reservoir of client data.
Right, okay. And the initial results, well, they certainly reflected that aggressive growth strategy. Total revenue for the quarter was $1,540 million. That's a very robust 17% increase year over year, and the number many investors watch closely. Adjusted diluted earnings per share also showed growth, hitting $1.22. That's a 5% increase. Solid. Those are the strong numbers, yeah. But here's where the story gets, a bit complicated. You have to look at the GAAP results. Generally accepted accounting principles, the unadjusted rules. If you looked purely at those GAAP figures, operating income actually decreased by 1% to $541.9 million. And GAAP diluted EPS, that dropped 10% to $1.06. This is the sort of crucial conflict of the quarter.
That difference. A 17% revenue increase, but a 10% GAAP EPS decline. That's the essential puzzle piece here, isn't it? If the business is growing revenue so well, why did the bottom line, on paper at least, look so bad?
It's entirely rooted in the, let's call it, financial friction of swallowing another massive company. They had $84.8 million in acquisition-related costs that get backed out of those adjusted numbers we just talked about.
$84.8 million. Can you break that down a bit? Where did that money actually go? Absolutely. So that expense, it covers everything from integration severance, professional service fees, aligning technology platforms, that kind of stuff. But the single biggest piece, and this is important, $61.1 million of it is non-cash amortization of acquired intangibles.
Okay, let's maybe clarify that for the listener. Amortization can sound like jargon. What does that really mean in this context?
Right. Think of it this way. When you buy a company like Paycor, you're buying assets you can't necessarily physically touch. Things like their client lists, their brand value, their tech patents, those are the intangibles. That $61.1 million isn't cash that left the bank account this quarter. It's the accounting department basically spreading the cost Paychex paid for those assets over their useful life. It creates friction on the P&L statement, sure, but it's not really a true reflection of the cash strength or the day-to-day operating power of the core Paychex business.
Okay. So once you correctly back out those integration costs, which are either non-cash like amortization or non-recurring like severance, the operating picture changes completely.
It really does. Once those items are removed, the adjusted operating income grew a very healthy 15%, hitting $626.7 million. This basically confirms the underlying operating model remains strong while they integrate the new platform. In fact, Paychex highlighted that they continue to significantly exceed what's known in the software world as the Rule of 50.
The Rule of 50. That's a great measure of efficiency, especially for SaaS companies. Can you define that for us?
Sure. It's kind of the ultimate sign of a successful, mature SaaS company. The Rule of 50 basically says that the combination of your adjusted EBITDA margin plus your revenue growth rate should be more than 50%. If you achieve that, it means you're successfully managing, explosive revenue growth and maintaining leading profit margins at the same time. And Paychex is currently blowing past that threshold, which is pretty remarkable given the scale and complexity of this Paycor integration they're dealing with.
That high efficiency metric provides really crucial context then. Okay, speaking of that high revenue growth, let's pivot and look at exactly where that 17% overall increase came from. Because, as you hinted, it wasn't spread evenly across the business, was it?
You're absolutely right. The main engine, the real acceleration came from the Management Solutions segment.
Right. Management Solutions revenue jumped 21% to $1.2 billion. This is clearly where Paycor's influence is most immediate. The report said the Paycor acquisition contributed approximately 17% of that 21% growth year over year. That's essentially instant scale right there.
It is instant scale, yeah. But there's quality to that growth as well. Beyond just the sheer volume of new clients, the growth was driven by two other key things. One was organic growth in client worksite employees using their HR solutions. The other was a crucial increase in revenue per client. And that increase in revenue per client, that's a direct result of inheriting Paycor's established upmarket client base, plus strong price realization and increased product penetration, particularly in high-value stuff like HR solutions and retirement services.
Okay, so compare that really blistering pace to the PEO and insurance solutions segment. That was different.
Yeah, the PEO segment growth was much more measured. It increased 3% to $329.1 million. The drivers were solid enough growth in the number of average PEO worksite employees and increased PEO insurance revenues, but definitely less dramatic than Management Solutions.
Should we be concerned about that slower PEO growth? Is it an indication that Paychex is just focusing all its integration efforts on Management Solutions, or is the PEO business just naturally slower growing anyway?
It's largely the latter. I'd say PEO is just a more mature and very compliance-heavy business. It's really focused on stability and long-term client retention. Plus, integration efforts for a co-employment model like PEO are significantly more complex. They require intense regulatory focus. So the strategic decision seems to be, maximize the transactional revenue and cross-sell opportunities on the Management Solutions side first. Get those synergies quickly, and meanwhile, maintain steady, reliable growth in the PEO side, which kind of acts as a foundational high-retention revenue base for them.
Okay, that makes sense as a tactical approach. Now let's talk about a really fascinating part of their business model. That third revenue component, the interest they earn on funds held for clients. That income stream increased a whopping 27%, hitting $47.6 million. Now, was that due to rising interest rates, or was it just holding more money?
It was overwhelmingly a volume story. And again, it ties back directly to the Paycor acquisition. This is their float business model, right? Essentially, Paychex gets to invest the funds clients have paid them for things like taxes and payroll, but which haven't yet been sent out to the government or the employees. When they bought Paycor, they instantly bought billions more in these investable funds.
So they acquired new clients, and bam, those clients immediately started generating interest income on their held funds.
Precisely. The average investment balances, that's the client funds Paychex holds, increased 26% over the prior year, reaching an average of $5.4 billion. And what's really telling is that the average interest rate earned on those funds, it remains stable at 3.5%. So that 27% jump in interest income is almost entirely because of the volume growth generated by the Paycor client base coming on board. That's a powerful financial synergy right there.
Okay, we've covered the income streams. Now we have to talk about the price tag and the cost side of the equation, which is the other side of that GAAP puzzle. Total expenses grew 29% overall to nearly $1 billion. Ouch.
Yeah, and even if we ignore that $84.8 million in acquisition friction we discussed earlier, compensation-related expenses still rose 17%. That's mainly due to the necessary increased headcount they absorbed from Paycor. And furthermore, other operational expenses, which include critical things like technology, selling, and marketing investments, they jumped 30%. This tells you Paychex isn't just sitting back after the purchase. They are aggressively investing to integrate and really enhance the technology platforms they just acquired.
And speaking of costs, we absolutely must address the sharp increase in interest expense. This is the second major factor driving that 10% gap decline we saw, isn't it?
It is absolutely vital context. Interest expense increased sharply by $58.6 million for the quarter, soaring up to $68.2 million total. And this increase is purely a function of the incremental debt. Specifically, they issued fixed-rate corporate bonds that Paychex took on to finance the massive Paycor acquisition. This debt load is the major financial difference between the GAAP net income declining and the adjusted net income growing. They made a conscious strategic trade-off, really. Sacrifice some short-term GAAP profit for long-term growth potential and that all-important scale.
But wait a second. Trading a 10% GAAP loss for, what was it, 5% adjusted EPS growth, plus taking on all that new debt, I mean, that sounds like a huge gamble. What reassurances do we have that the company can actually absorb this debt and that those Paycor synergies will materialize fast enough to cover the interest expense?
Well, the first reassurance is just the raw operational cash flow. The company is a cash-generating machine. Operating cash flow for the quarter was robust at $718.4 million. They also maintained strong liquidity, about $1.7 billion in cash and total corporate investments, so they're definitely not strapped for day-to-day capital. And secondly, they remain highly committed to shareholders. They returned $549 million during the quarter through dividends and share repurchases. You don't usually do that if you're feeling financially stressed.
Right. And I suppose the ultimate reassurance has to be their forward guidance. If management were nervous about the debt or the integration progress, they probably wouldn't be raising their targets, would they?
That's the key positive signal, exactly. Paychex actually updated its outlook for the full fiscal year 2026. They raised their forecast for adjusted diluted EPS growth to a range of 9% to 11%. That's up from their previous 8.5% to 10.5% range. So that indicates management is highly confident they can achieve those targeted Paycor revenue and cost synergies, maybe even faster than anticipated. And the total revenue growth outlook also remains strong and steady at 16.5% to 18.5%.
Yeah.
No backing down there.
So this deep dive, it really boils down to reading the correct scorecard, doesn't it? The spectacular 21% growth in management solutions, that really validates the strategic thinking behind the acquisition.
Exactly. The integration costs and the debt financing, yeah, they temporarily suppress the GAAP profits. That's just the required price of expansion at this scale. But the operational strength of the core business, which is validated by the adjusted results and especially that aggressive guidance raise, it shows they're on track. They successfully invested in scale, they got that upmarket penetration, and they're instantly generating more interest income from their much larger pool of client funds. It seems to be working.
And that leads us, I think, to the real long-term competitive prize here. Technology and data. Paychex specifically cited ongoing strategic investments in AI, extended data assets, and their unique blend of compliance expertise and tech.
Right. They now have an exponentially larger pool of client data thanks to Paycor, and that feeds directly into their AI development efforts. Think about the complexity of payroll, benefits, PEO. The compliance burden is just enormous. The companies that win long-term in this space won't just have the best software, they will have the best data to feed their AI models. That'll help them automate complex regulatory tasks and ultimately improve the client experience.
And that's the final thought we want to leave you with today. Given Paychex's successful integration so far and this resulting massive expansion of their proprietary data assets, the question for you to consider is this: how significantly will this enhanced data advantage boost their AI capabilities? And what will the long-term competitive advantage really be for a company that can truly integrate AI into these complex, high-stakes regulatory environments like PEO and payroll?
Yeah, the compliance automation race is really just beginning. It's going to be fascinating to watch.
A truly fascinating competitive landscape indeed. Thanks for helping us navigate those somewhat complex financials today.
Always a pleasure to dive in.